Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Analog Devices stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Analog Devices is a semiconductor company specializing in data conversion, signal processing, and power management technology. The company is headquartered in Norwood, Massachusetts, and was founded in 1965. It went public in '69 and currently trades on the Nasdaq, Deutsche Börse, Xetra, Vienna, Mexican Bolsa, Euro TLX, and London stock exchanges. It is the leader in the data converter market with a 49% share. The company manufactures analog, mixed signal, and digital signal processing integrated circuits used in electronic equipment. Its products are used to convert light, sound, temperature, motion, and pressure into electric signals. It has 100,000 customers in the following industries: communications, computer, instrumentation, military and aerospace, automotive, and consumer electronics. Let's get started with the model. This is a large cap company, 58 billion market cap. They're trading at $157 a share, and they have 369 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see that free cash flow grew a lot from 2018 to 2019. Then it's pretty steady after that. Net income is the profit and loss on the income statement. That's revenue minus expenses. And that grows from 700 million to 1.5 billion, then 1.4 billion, and 1.2 billion in the trailing 12 months. Revenue is the sales for the company. That's pretty steady. It did peak in 2019 at 6.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit. They had their highest gross profit in 2018 at 4.2 billion. It's currently 3.9 billion. Below that is operating expenses and then operating income. And they had their highest operating income also in 2018 at 1.9 billion. It's currently 1.7 billion, up from 2020 of 1.6 billion. They paid 187 million of interest on their debt, which is the lowest amount they paid in the past 4 years. Then you have other income and expenses. This is usually impairments or write-offs. And the bottom line of the income statement is their net income. And that peaked in 2018 at 1.5 billion. It's 1.4 billion in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Their operating cash flow seems to be decreasing. It was 2.4 billion. Now it's about 2.1 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have a lot of free cash flow each year, about $2 billion a year. They do pay $1 billion in dividend payments. So they have $1 billion left over to buy back stock, which they do every year. They bought back 226 million in 2018, then 600 million, then 245 million. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They're also doing a good job at reducing their debt load. They issued $700 million of debt in 2018, but paid down 2.3 billion. So they decreased their total debt $1.5 billion in 2018. They decreased it $800 million in 2019 and $400 million in 2020. Let's look at the capital structure. $12 billion of equity, $5 billion of debt. They're 70% equity, 30% debt. Their net debt is $4.1 billion and their WACC is 7.41%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 47 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $42 billion. We divide that by 369 million shares. And we get a calculated stock price of 114. They're trading at 157, so they're trading at a 38% premium. It's a sell according to the model. Simply Wall Street is at 172, so they're saying the stock is undervalued. They're saying it's a buy. 13 analysts priced this stock and the average price target was 180, the low was 160, the high was 200. This is a stock price the last 5 years, so it looks like it's only gone up. It did take a dip last March when the market crashed, but it came way back up past its all-time highs. They seem to raise their dividend each year. They were 42 cents back in 2016. Currently it's 69 cents a share. They pay a 1.76% dividend yield. They pay out 83% of their net income, 55% of their free cash flow. Their industry pays a 1.4% dividend yield, so they're above their industry. And analysts are forecasting their dividend to grow from 1.8% to 1.9% in the next 3 years. Their beta is a little over 1 at 1.29, so the stock moves a little more than the market. The stock has gone up 43% in the past 52 weeks, while the S&P 500 went up 45%. The 52-week low was 100, the high was 164. And the stock is trading above its 50-day and 200-day moving average. About 3 to 4 million shares are traded each day on this stock. Of the 369 million shares outstanding, 368 million are on float, 97% are held by institutions, and 10% of the shares are shorted. In the past year, 3 years, and 5 years, this stock has done worse than its industry. In the past year, this stock has underperformed the market, but outperformed the market in the past 3 years and past 5 years. Analysts are forecasting their earnings to grow 15%, its industry 16%, and the market 16%. Analysts are forecasting their revenue to grow 7%, its industry 8%, and the market 9%. In the past 5 years, their annual earnings increased 14%, its industry increased 14% also, and the market increased 12%. In the past year, their earnings increased 16%, its industry 46%, and the market 14%. If you invested $10,000 into this company 10 years ago, you'd have $49,500 today. That's a 395% return. The biggest shareholder is Vanguard at 8.6%, then BlackRock, JP Morgan, State Street, and MFS. Let's look at their financial ratios. The average PE is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 47.5, so investors are paying $47.50 for $1 of earnings. Price to sales is 10.4, which is worse than the median and average. Price to book is 4.8, which is between the median and average. And the way you calculate price to book is stock price over book value per share. Book value per share is equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $12 billion of equity, negative $3.7 billion of tangible equity, since they have $16 billion of intangible assets on their balance sheet. Their return on invested capital is 9.9%, interest coverage ratio of 9.3, and they have a good ROE at 10.1%. Their current ratio is 1.6. Their current assets are $1 billion of cash, $800 million of receivables, and $600 million of inventory. So the company does seem to be well capitalized. They had $1.8 billion of free cash flow, $900 million of working capital. Working capital is current assets minus current liabilities. And they pay $1 billion in dividend payments. So they have about $1.8 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 16 companies in the same industry as ADI, and if ADI has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in PE and price to sales. They are doing better in price to book. Their current ratio is worse than average. Their ROE is a lot lower than average. They're a little lower in debt than average. And they're a big company, 58 billion market cap, but the average in this industry is really high at 121 billion. There's some really big companies. And their dividend is above average at 1.8%. The average, according to my list, is 1.25%. So to summarize, I have them trading at a 38% premium. And the semiconductor market is a very big and important market. And this company fulfills a specific niche within that market. They're a big company, they've been around a long time, and they're still generating solid revenue and free cash flow. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.